wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 185, and in this episode we are reviewing the performance of the financial markets during the 45th week of 2025, and that is from Monday the 3rd to Friday the 7th of November. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where due to the ongoing U.S. government shutdown that entered its 38th day on Friday, the Bureau of Labor Statistics for the second month in a row did not release the employment report for October. In the absence of the non-farm payrolls report, the market shifted its focus to the ADP report, which tracks the payrolls for private companies. The ADP report that was released on Wednesday showed that the growth of payrolls in private companies was slightly stronger than expected in the month of October, providing some hope that the labor market was not in danger of shrinking. The report showed that private companies added 42,000 jobs in October, following a decline of 29,000 jobs in September, and came out ahead of the Dow Jones consensus estimate for a gain of 22,000 jobs. Over to the United Kingdom. On Thursday, the Bank of England voted by a narrow margin to keep interest rates on hold, deciding to exercise caution ahead of the government's autumn budget in November. Out of the 9 members of the Monetary Policy Committee, 5 members voted to keep the bank rate on hold at 4%, whilst the other 4 members opted for a rate cut of 25 basis points. The Bank of England Governor Andrew Bailey signaled that a rate cuts were in the pipeline, with economists pricing in a rate cut as soon as December. However, the governor was non-committal on the timing of the next rate cut and said that the committee would be watching inflation and labor market data that will be released before the next monetary policy meeting that is scheduled to take place on the 18th of December. Over to the Eurozone, where inflation slowed down slightly in the month of October as it continued to hover around the European Central Bank's target rate of 2%, confirming the central bank's message that the Eurozone economy remains relatively weak. According to data from Eurostat, inflation in the 20-nation common currency trading bloc slowed down from 2.2% in September to 2.1% in October, which was in line with market expectations. Meanwhile, the closely watched core inflation rate, which excludes volatile food and energy prices, this held steady at 2.4% as services inflation picked up from 3.2% up to 3.4%. The European Central Bank held its key policy rate at 2% the previous week, arguing that inflation remains on target and that some of the downside risks related to economic growth had declined, keeping the Eurozone on track for unacceptable but unspectacular economic growth. On Wall Street this past week, all the three major indices initially declined on Friday, pressured by losses in artificial intelligence stocks as new economic data added concerns about an economic slowdown. A survey from the University of Michigan showed that consumer sentiment was approaching its lowest level ever, mainly due to the ongoing government shutdown. However, later in the session, stocks recovered from the morning dip after the Senate Majority Leader offered a new plan to Republicans that could facilitate the reopening of the U.S. government. All the three major indices closed the week in the red as concerns persisted about elevated valuations for the tech sector, accompanied by a highly concentrated market. The tech-heavy Nasdaq Composite was down by about 3% for the week as it came to a close at 23,004. Meanwhile, the broad market index, that is S&P 500, fell by more than 1% during the week to settle at 6,728, whilst the 30-stock Dow Jones Industrial Average also declined by about 1% to close the week at 46,987. In the government bond market, U.S. Treasury yields were little changed on Friday as investors continued to deal with a blackout of economic data due to the ongoing government shutdown. Investors were optimistic that the shutdown might soon be coming to an end after the Senate Majority Leader proposed a new plan to Republicans that would offer short-term government funding in exchange for extending the Affordable Care Act. In the meantime, the blackout of economic data has forced investors to rely on alternative data sources in order to decipher how the U.S. economy is performing. Case in point is a recent survey from the University of Michigan that showed consumer sentiment was approaching its lowest level ever. In response, the yield on the 2-year Treasury note was down by less than 1 basis point at 3.55%, whilst the yield on the benchmark 10-year Treasury bond was flat at 4.09%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall and vice versa. In the commodity markets, the price of crude oil rose on Friday but still posted a second consecutive weekly loss on concerns about excess supply and the ongoing government shutdown, which continued to cloud economic activity and point to slowing demand from the United States. On Wednesday, the Energy Information Administration said that the U.S. crude stocks rose more than expected on the back of higher imports and reducing refining activity. According to an IG markets analyst, there was an unexpected buildup in U.S. inventory of 5.2 million barrels that reignited concerns about an oversupply in the oil markets. Concern over the effects of the longest government shutdown in U.S. history has also pressured oil prices as the global benchmark Brent crude posted a weekly decline of about 2% to settle at $63.63 a barrel, Whilst the U.S. benchmark, that is West Texas Intermediate crude, this also declined by a similar margin of 2% to close the week at $59.75 per barrel. In the precious metals market, the price of gold rose on Friday as the dollar softened and also as uncertainty around the U.S. government shutdown increased the safe haven demand for bullion. With the U.S. government shutdown delaying the release of the monthly non-farm payrolls report, traders turned to private sector data to gauge the likelihood of another interest rate cut this year. According to the CME's FedWatch tool, the markets are now pricing in a 67% chance for a 25 basis point rate cut in December. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. In response, the price of spot gold, which has increased by about 53% so far this year, this was up marginally on Friday as it came to a close at $4,007 per ounce. In the cryptocurrency market, for the first time in more than 4 months, the price of Bitcoin plunged below $100,000 on Tuesday as crypto holders backed off from the risk-on asset amid growing concerns about the sustainability of stock valuations that have been driven by the artificial intelligence trade. The flagship cryptocurrency tends to attract many of the same investors as artificial intelligence stocks, linking the two trades, especially when one goes bad. The Nasdaq Composite, which is home to the leading AI stocks, dropped more than 1% on Tuesday and in the process pulled down the price of Bitcoin together with other major cryptocurrencies. The price of Bitcoin was down by 5% on Friday and was last seen trading at $100,893 per coin. In related news, Bill Winters, the CEO of Standard Chartered, said he foresees a future in which nearly all global transactions are conducted on a digital blockchain ledger as crypto adoption amongst traditional financial institutions continues to grow. Under a new regulatory framework that was launched by Hong Kong City in August, Standard Chartered Bank, in partnership with Animoca Brands, which is a blockchain venture capital firm, and HKT, which is a telecommunications company, these three companies are jointly planning to launch a stablecoin that is backed by the Hong Kong dollar. We now change scene to the Kenyan financial markets, and as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.23. Meanwhile, the sterling pound was priced at 168.49 and the euro was valued at 148.41. And on the regional front, one Kenyan shilling was changing hands for 27.02 Ugandan shillings and 19.04 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.25. The International Monetary Fund has recently raised concerns about the stability of the Kenyan shilling, and in response, the central bank insists that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years, and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by $31 million for a grand total of $12.16 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this massive increase in reserves, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 9.25% and remains in line with the central bank rate, which is also at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 12.3 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 6th of November, and the central bank received bids totaling to 39.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 166%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate dipped by about 2 basis points to settle at 7.79%, whilst the 182-day rate plummeted by 10 basis points and was at par with the 91-day rate at 7.79%. And the 364-day rate remained unchanged at 9.34%. In the primary bond market, the auction for the November bond issue was held on Wednesday, the 5th of November, and the central bank ended up receiving bids totaling to a whopping 92.9 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of 232%. The central bank ended up accepting only 52.8 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2012 and now has 7 years left to maturity, the central bank accepted 19.4 billion shillings at a weighted average rate of 12.47% compared to the bond's coupon rate at 12% flat. And for the second bond, which was a 15-year bond that was initially issued in 2022 and now has 11.4 years left to maturity, the central bank accepted 33.3 billion shillings at a weighted average rate of 13.33% compared to the bond's coupon rate at 13.94%. In related news, the Kenyan government is looking to issue a 15-year mega bond worth 390 billion shillings in order to fund the extension of the standard gauge railway from Naivasha to Malaba, and this is after China signaled its unwillingness to finance the project. The Cabinet Secretary for Roads and Transport said the government was considering issuing a securitized bond where investors would be paid using revenues generated from the Railway Development Levy, which is estimated at about 39 billion shillings per annum. Due to its rising debt burden, Kenya is seeking alternative ways to finance infrastructure projects with a focus on public-private partnerships and securitizations where bonds are backed by income-generating assets. At the Nairobi Securities Exchange, during the past week, the equities market was on an upward trajectory, with the NSE 10 rising the most by 5.3%, whilst the NSE 20, the NSE 25, and the NASI gained by 4.4%, 4.2%, and 2% respectively. This takes a year-to-date performance to gains of 58.1% for the NSE 20, and on the lower end we have the NSE 25, which is up by a respectable 50.6%. The market's performance was mainly driven by gains recorded by large-cap stocks such as Kenya Commercial Bank, Absa Bank, and DTB Bank, which increased in value by 13.8%, 12.4%, and 9.8% respectively. This performance was however weighed down by losses recorded by other large-cap stocks such as NCBA Bank, Safaricom, and Stanbic Bank, which declined by 3.4%, 2.5%, and 0.6% respectively. In related news, Safaricom has disclosed that it has increased its shareholding in Safaricom Ethiopia from 51.67% to 53.37% after converting a shareholder loan into equity. In the 6 months to September 2025, shareholders of Safaricom Ethiopia completed the conversion of a 2.3 billion shilling loan into equity, contributing to Safaricom's increased ownership. The other shareholders in Safaricom Ethiopia are Sumitomo Corporation with a shareholding of 24.02%, British International Investment with 9.71%, International Finance Corporation with 6.97%, and Vodacom Group with a stake of 5.93%. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as of September 2025 stood at 12.05 trillion shillings, and this was divided between domestic debt, which stood at 6.6 trillion shillings, and foreign external debt that was valued at $41.7 billion, which is equivalent to 5.4 trillion shillings. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. In response, the National Treasury has developed a medium-term debt management strategy for 2025 that aims to reduce the debt-to-GDP ratio from 64% down to 57% by 2028. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue. And this week, we are looking at the IMF's concern about the stability of the Kenya shilling. The Kenya shilling has remained suspiciously stable against the US dollar over the past 1 year, and this stability is now at the center of discussions between Kenya and the International Monetary Fund. For most of 2025, the shilling has hovered around 129 shillings to the US dollar, and according to the Central Bank of Kenya, this stability has been supported by strong foreign exchange reserves as well as improved balance of payments due to strong diaspora remittances and a sound monetary policy. However, the IMF has expressed concern that the shilling's limited fluctuations may be affecting the transmission of monetary policy and complicating inflation targeting. The IMF's concerns were raised during a recent staff mission to Nairobi that was aimed at assessing Kenya's current economic situation and to discuss the possibility of a new IMF program. The central bank's position is that Kenya continues to embrace a floating exchange rate policy and only intervenes to smoothen out excess volatility. However, the data appears to contradict the central bank position because whilst the shilling has remained extremely stable versus the US dollar, it has weakened against other major currencies such as the euro and the sterling pound, where it has depreciated by 12% and 6% respectively. The IMF is tasked with the responsibility of overseeing the international monetary system to ensure its effective operation, and that role entails the stringent surveillance of members' exchange rate policies. In that regard, Kenya, as a member of the International Monetary Fund, has an obligation to maintain a freely floating exchange rate policy where market forces determine the value of the Kenya shilling. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, your life will shrink or expand in proportion to your courage and your belief. Think about it. Thank you, and God bless.